So, hey, so tell me about yourself and how long you've been in business.
So I'm Kimi Ortega, and I am a mortgage lender. I've been doing mortgages since 2008. So if we do the math, that's going on 17 years, right? Yeah. So that's basically all I've done since college, and so I started out in the business actually in subprime, which yes, that's a scary word because that's caused some economic issues, but it actually taught me a lot about how to get past challenges to be able to solve financial problems that a lot of people were having. So subprime does have a bad name, but it did do some good for a lot of people who were in some bad places. So it's what got me started and what got the wheels turning to be able to solve great problems and help people get into homes and do that kind of
So,
thing.
with a start off like that, does that make you particularly good at helping first time buyers, for example?
I would say that it helps me really more with anyone who has any kind of credit financial challenges, which it is a lot of first time home buyers because as a society, we're just not really taught financial literacy, in high school and, any of the schools up to that or even in college. And so we learn our financial habits from our parents, and sometimes our parents don't have great financial habits. And so a lot of it's trial and error. And so I feel like, that experience equipped me to help give that financial and credit education to turn that trajectory and help someone be better in their credit and financial. Yeah.
So, what exactly does a loan officer do and how are you involved throughout the buying process?
Wow, what does a loan officer do? We wear many, many hats, but we can be counselors at any given time. But no, honestly, we're advisors. So our job is to help take someone from having that I want to buy a house one day to getting them to the finish line at the closing table. And so there's a lot that can happen in between that, but it's looking at where do we stand right now with our whole financial picture, where what's our credit look like, what income do we have, what debts are we currently obligated to, how much room is left for a mortgage payment, and does that make sense for your budget. So it's really analyzing the current financial situation, but also strategizing to see, can you do what you're looking to do? Does that align with your goals? Because sometimes some people need more time to plan. And so we have lots of planning sessions and conversations. Sometimes people come to us and they're already ready, but our job is to help people figure out what needs to happen to achieve the goal of homeownership. And so there's a lot involved in that process of looking at documents, and we have to wear all the hats to be proactive in our thinking, so that we can look at, okay, what is an underwriter going to look at? How are they going to view this employment type or this pay structure? Or we have to look at things like that from those perspectives to try and be proactive and make sure that when you guys do go out and go shopping for a home, that it's we don't have any barriers. We don't have any issues where an underwriter is going to say, oh, well, the income's actually this. Like, we want to try and wear an underwriter hat. So not only are we trying to advise of here's what's possible or here's what we think you should do based on your goals, but we also have to put on an underwriter hat just to make sure that we're protected and looking at things from that perspective. And as far as what else a loan officer does, like I said, we're cheerleaders. So we want to cheer along the way and celebrate successes. But that's kind of in a nutshell. But yeah, I feel like there's a lot more.
So, when you're thinking of affordability for a potential homeowner, is it just the loan payment you're thinking of that they can afford, or is there another payment such as property taxes that they might need to take into account for affordability for a house they're buying?
Absolutely. So whenever we're looking at affordability, we're looking at not only is what is your income, what are you currently already obligated to do, but when we're talking about a mortgage payment and we're asking them what can you afford to pay, we're taking into consideration property taxes, homeowners insurance, the mortgage payment, principal and interest, and then also if they're putting a lower down payment, then it would be PMI as well. But that's something that every recommendation we make is goal based, and so when people come in and say, I'd like to get pre-approved, we don't just say, okay, great, and then here's what your maximum pre-approval is for. The next question is, okay, great, what payment are you able to spend every month? And then we work backwards from that to say, okay, if you're wanting to spend $2,000 a month on your mortgage, then here's what price point that equates to based on what, loan program we're doing, interest rate, what you're putting down, all of that.
So talking of pre-approval, that leads me nicely on to my next question, which is, what's the first step that someone should take when they're thinking about buying their first home?
Yeah, so that's an excellent question. So the first step is to speak with the lender, with someone like myself, because we are going to look at it from where do you want to be, where are we now, and what steps do we need to do to get there. There's obviously a lot on the internet. There's a lot on TikTok and YouTube and all those things of different tips and tricks and tidbits, but really I feel like the best approach is a tailored one, and that way you're not guessing. Because the worst thing is that someone is like, hey, you know what, I need to fix my credit first, and then I'll get pre-approved. But they could be spending money in completely the wrong places and have no higher credit score, and then they just use their money that they could have spent for a down payment. So we just want to make sure that whatever you're doing, if you do have some homework, so to speak, that it's effective. It's an effective use of money, and we're not wasting money. Yeah.
So do you know of any common myths or misconceptions for first-time buyers have about getting approved for a loan?
Oh yeah. Let's see. A lot of people feel that they have to put a ton of money down, like 20%. I still hear that all the time. And one of the benefits of being a first-time home buyer is that, for a conventional loan, the down payment requirement is as low as 3%. And there are down payment assistance and special programs that can help cover that. There's even, depending on where you're buying, if you're out in a rural area, there's down payment options for USDA as low as 0%. So there's a lot of other options to get into a home with a lot less money. And I will just say, like, a recent example is I had a single mom who she's, limited income, fixed income, and she is buying a roughly $215,000 home. And I believe her income is maybe 60 grand. I should have fact checked that, but somewhere around there, right? But her total out of pocket is going to be less than $1,000, because with down payment assistance and what the seller is contributing towards closing costs, when it's all said and done, her total out of pocket will be right at about $1,000. So, which is not everyone, right? So don't go in expecting that. But our market here in the DFW is a buyer's market, which means a lot can be negotiated in the buyer's favor, like closing cost help. So it is very possible with the right realtor, and also with the right strategy from a lending standpoint.
What kind of credit score do most lenders look for, and is there any kind of flexibility there?
Oh yes, great question. So we have financing options as low as 500 as far as a credit score. They are not great if they are below 580, right? So from a credit score standpoint, really it depends on what you have to put down. So if you are financing your own down payment and you've got, you're not trying to use down payment assistance, then really you can get away with as low as 580, and not be atrocious terms. So, but if we are looking to use any kind of down payment assistance, we really need to have a 620, and that's not a lender-specific rule. That is specific to the down payment assistance programs.
I do think you've kind of half answered my next question as well, which was, if somebody has less than perfect credit, what can they do to still move forward with buying a home? Most people I think that buy homes have less than perfect credit already, right? Because if you have a 620, it's already less than perfect, because perfect is closer to 800, right? So just because you have a ding here and there, or if you've had some slip ups, you missed a payment, or maybe something happened with the credit, it's not the end of the world.
It is not the end of the world, and I find that people are their own worst enemy whenever it comes to that, because they just say, nope, I'm not good enough, my credit's not good enough, I'm not even going to try. And most of the time when people come to us, there's a way to yes. And even if it's not a yes right now, it's here's what you need to do to get there, and we'll give you a very specific, pay this down, pay this off, wait 3 months or whatever, because we have the ability to use some really cool tools and simulators, so we can be very tailored and not guess of, hey, if your credit score is, let's say, a 610, and we really need that down payment assistance, so we need to be at 620, we don't just guess and say, oh, well, try paying this down and we'll see if that works. It is not that way. It is very specific of, pay it down to this exact balance. We're going to wait a month, and exactly it will be at 630 or whatever that score target is.
That's good, because a lot of lenders are very vague in that kind of area. So I've heard of something called debt to income ratio. What is it, and how can buyers prepare for that?
Excellent question. So a debt to income ratio looks at what all qualifying income that we have between all people who are going to be on the loan. And I want to be very clear on that part, because let's say that there's a husband and wife that both live in the house, but only one person wants to be on the loan. Well, we can only use that person's income. So it's not household income, but it's looking at the total qualifying income. And so qualifying income is income that is allowed to be used based on the guidelines set forth by the investors, such as FHA, USDA, whoever. So sometimes there's income that maybe there's, under the table income that we can't use. So qualifying income is just specifically what is eligible to be used. And then the debt part of that is what monthly payments are you obligated to? And it's not everything you pay under the sun. It's what is on the credit report, like credit card payments, installment loan payments, car loan payments, student loan payments, things like that. But also child support. There are some other things that maybe aren't on the credit report that we would have to count into the debt to income ratio, but it's looking at what all monthly obligations are you already paying out? What income are we able to use? And then what is left in that percentage that's allowed, which is the debt to income ratio, that can be used towards a mortgage payment. So let's say, for example, our monthly income is $10,000 a month. And with the loan program that we're doing allows for a 50% debt to income ratio. That means $5,000 a month can be allocated towards existing debt payments and the new house payment. So let's say that your car payments and credit card payments, child support, everything adds up to $2,000. Then that means, if our total allotment's $5,000, we already are paying $2,000, then that means $3,000 could be used towards a mortgage payment, inclusive of taxes and insurance. And so we would take then that number and reverse engineer based on what we're putting down, what that price point could be.
Cool.
So.
Yeah. So on to types of loans. What are the main types of loans that first-time buyers should know about, and how do they compare?
Oh yeah. So FHA is a great program for first-time home buyers because it's 3.5% down.
It's a really common one.
It is a very common one. So it allows for a lesser down payment, but also it is very forgiving when it comes to any kind of credit challenges that have happened in the past. And so not that they 100% look the other way, but they take on more risk. And so they're more likely to say yes if you've forgotten a payment here or there. And so a lot of times if there are credit concerns and if we do want, a lower down payment, FHA is usually a great solution for that. It fits, a lot of people fit into that box. Another program is USDA. So that is a 0% down payment program. Now it's location specific, and so it's made for rural type areas, and so it's not like if you're in the meat and potatoes of the Metroplex, like in Fort Worth where I'm at. Even though we are Cowtown, we are not USDA eligible. We are too highly populated. So you're going to be looking at places there's actually a map that you can go if you just Google search USDA property eligibility, then you can go to the website directly and you can put in a specific address and it will tell you, yes, it's USDA eligible, or no, it's not. So it's not like a subjective decision. It has to say yes on that map search. But you're looking at places, outside that are more, rural. So like Granbury, for example, Springtown, Azle, and kind of beyond, at least if you're looking at the west part of the Metroplex. You can kind of see the map if you look at that website, and it will tell you. So it just depends on where you're looking, but that's a great one to know about. And then there are down payment assistance programs that kind of layer on top with those FHA, USDA, VA, conventional, whatever. But FHA is a great one for first-time home buyers. A lot of people utilize that. I used it for my first home.
Okay. So if you're fortunate enough to have a good down payment, what kind of loan would you recommend for somebody in that kind of position, has reasonable credit and a good down payment?
A conventional loan would be a great solution to explore. And so conventional, if you're a first-time home buyer, is as low as 3% down. But the more you put down with conventional, the better the terms get. And so if you have 5% to put down, 10%, et cetera, then you get a little bit better terms interest rate-wise, but also within what's called your PMI, or private mortgage insurance. So PMI is something that's paid whenever you're not putting 20% down, but it's not on there forever. It's only on there until you have reached the point where you've built 20% in equity between the value of the home and what you owe on the mortgage.
Cool. And are there any down payment assistance programs or grants in Texas that buyers should know about?
Oh yes, there are several. So in order of preference, my top 3 favorite are, so Texas has a lot of really fun acronyms. So we in the business will say, okay, the first one is TSHAC, and that sounds a little weird, but it's the Texas State, Texas State Affordable and Housing Corporation, something like that. Yeah. Anyways, it's TSAHC and .org if you would like to look that up. But it's a great option because it allows for this down to the 620 credit score. It has down payment assistance options up to 5%. So you can get your down payment your down payment covered and a little bit of your closing cost. And the rates are really not not bad at all. They're pretty close to market rate, and so and the repayment terms are also pretty ideal. So there are some national down payment assistance programs where, let's say you're getting that 5% or 3%, whatever you're getting in down payment assistance, but then you're actually you have to make payments on that after closing. So it's really just a loan. And so the reason why I like our state-based programs like TSHAC, and then there's also TDHCA, and there's also SETH, again, all fun acronyms. But the reason why I like them is because you don't make any payments after closing, and there's an option for them, or an opportunity for them, to be forgiven and not have to be paid back. Sometimes they do have to be paid back when you sell the home. It just depends on which option we look at and the timing of how quickly you sell after you buy, but at least there's no payment being made after closing. You never pay more than what you got on closing day. It doesn't accrue any interest or fees. So worst case scenario, it becomes an interest-free loan if you do have to pay it back. But it really is a great option compared to some of the other ones that are out there.
And can you explain the difference between pre-qualification and pre-approval and why it matters?
Yes, that is a great question. So a pre-qualification just means that we have looked at your credit basically, and based off of stated information, so unverified income, assets, and anything else that's needed to make an underwriting decision, that based off of stated information, you qualify. Now, a pre-approval means that we have actually collected all the documentation that underwriting is going to look at, so your pay stubs, your W-2s, tax returns, bank statements, child support orders. I mean, if there's anything that an underwriter is going to require that is looked at, we look at that ahead of time and then release that pre-approval letter. If you're shopping based on a pre-qualification, there's a lot more room for obstacles or landmines to happen once you do go under contract and an underwriter looks at your file. It is something that we actually don't really do pre-qualifications, and it's for our buyer's protection, because if we release a pre-approval letter or pre-qualification letter and we didn't do our due diligence, then what we are doing is putting that buyer at risk, because as soon as you go under contract, you're scheduling an inspection, which an inspection these days costs what, $500-600 maybe. And so that's money that we don't want you to spend if you're not going to get approved. And we want to make sure that we have no barriers to approval. So we look at everything an underwriter is going to look at, and we make sure that, okay, we're good to go. There's no chance of this falling through the cracks. I mean, or very little chance. We can't control if you get fired or something like that.
Yeah,
but
make sure people are properly approved before
Yeah.
they start laying out money unnecessarily.
Exactly.
Yeah. Okay. What is the one thing that you wish every first-time buyer, every buyer knew?
Ooh,
Before they started looking at homes.
Yeah, I wish that I will say that my buyers do know these things, but for those who don't work with, a lender that is like me and it has a process like mine, I want them to know what their payment is from the get-go. I want them to have a goals-based shopping budget, and because a lot of lenders don't do that. They just say, what do you want to be approved for? Great, here you go. And they don't really spend time understanding, okay, this price point equals this monthly payment with taxes, insurance, and everything. Can you truly afford that? Because the last thing that I want is for someone to have, buyer's remorse, but really it's like I don't want them to have any kind of financial stress. I don't want to be the reason someone can't sleep at night because they don't know how they're going to afford their mortgage, And so I think that really that's the most important thing is make as a buyer, make sure you have a goals-based shopping, price point.
Absolutely. And are there any red flags that might delay or even prevent a loan from being approved, even late in the process?
Yes. There's a lot because underwriting guidelines are over 1,000 pages long, and
How long have we got?
Yeah, how long do we have? I would say some of the biggest red flags are if there's a bunch of money being transferred from different sources, like if you're moving between different banks a lot, that can be a red flag. Depositing large sums of cash, that is a red flag, because while cash is king in many industries, it is not friendly in the mortgage industry, because we are held to anti-money laundering acts and regulations, and so we are required to comply with those and make sure that any money that's being used for a mortgage transaction has a source. And so cash is hard to source unless we can show that there were previous withdrawals or something, or you sold a boat, or something that can account for that large amount of money. So we just say don't deposit cash, or if you do have cash that you want to use to buy a home, get it in the bank well before you're buying a house. That way, it doesn't become an issue. But other red flags are if, we had this happen recently, but if someone's trying to buy a house that's, 90, 100 miles away and say that's their primary home, but is that a reasonable commute, right? So that's occupancy red flags. And so there's things like that, because if you're buying a home as a primary residence, you're getting the benefit of lower interest rates, better terms, lower down payment. And so you have to, you can't say you're going to live somewhere and then rent it out, because that's not good. So those are red flags. And then I would say also, if you have payments that are being made, recurring payments coming out of your bank account that are not on your credit report, like I would say Affirm, like some of those buy now, pay later kind of, type accounts. Those can pose a challenge sometimes. I wouldn't say it's necessarily a red flag, but it just can be a little bit of a challenge. So I would just say really, cash is the big one that we get into a lot.
Anti-money laundering.
Yes.
Yeah. So what are some avoidable mistakes that buyers make during escrow that could jeopardize their financing?
Do not, for the love, open any new credit accounts. So
buy a new car.
Yeah, do not buy a new car. But even if someone said maybe they want to actually sell their car and get a lower, less expensive car to them, it's a good financial decision, and yes, it could help because you're lowering your payments, but it becomes a documentation kind of not nightmare, but it just can be very tedious. But also it can affect credit. There's a lot of things that can happen. So if there's anything that you're trying to do financing wise, even if it feels like you're making a smart decision, just talk to us first so we can say, hey, that's great, but let's wait. Or that's great, but here's what to prepare for if you do make that decision. We need to get this, this, and this, and this. But I would say that's one of the big ones as far as, things that can go south. Or let's say that you've gotten a job offer and it's a better job and you're getting paid more. Just don't start that and quit your current job until after you've closed. Or if you are going to start that new job, let us know, and that way we can close with the new job and new employer and get all that documented. Because job changes in the middle of a transaction are not great.
Nightmare.
Yeah, a lot of times they're solvable unless your pay structure is changing. We've had that happen before, where someone is salary or hourly and then they go to commission at the new job. Well, commission requires a 2-year history, and so then now income is no longer eligible. So
you might not be able to get a 2-year history in that few weeks before closing.
No. No.
So how do you work alongside agents like me to make sure the process is smooth for the buyer?
Yes. Communication is key, and proactive communication at that. And so we make sure that at least once a week, every Tuesday, we send updates to make sure you know exactly where are we at with the appraisal, where are we at, what's outstanding, what's our status with underwriting. But we also send updates throughout the way, or throughout the process, to let you know when we've submitted, when we've gotten it back from underwriting, when we've ordered the appraisal, all of those things. That way you can know where we are at any given time. I would say the biggest thing is just, communication. And then if something does happen, let's say there is an oopsie that someone does on one of the sides, it's, hey, let's talk about it together and let's solve it as a team and not hide from it, right? We don't hide behind our computers and shy away from hard conversations. It's, hey, it's a team-based solution finding approach.
And what should a buyer expect from a great loan officer that sets good ones apart from the rest?
I would say transparency and communication as well. I think big thing is having the strategy conversations, the goal-based conversations. We're not a press button get mortgage, and I don't think that's setting anybody up for success, because it's important to really understand, okay, here's option 1, 2, and 3 are different ways that we can do this, because it's not a one size fits all for mortgages, and we want to help make sure education is really important. And my goal is when we have our consultations with clients after we've looked at credit, we've looked at everything, and we present options that are truly based on what they can be approved for. We want to make sure that they are empowered to make those informed decisions. And it's not just, we're not dictators, right? We're not going to tell you, this is what you have to do, this is your only option. Even if we feel like option number 3 is the best, we want to present all 3 options and let the client decide. So I think that, working with a really, strong loan officer, it's about getting that education and having those, that advice.
Excellent. And final question, what's your best advice for someone who's nervous about making that first big step into home ownership?
Well, I would say for us, this is a judgment-free zone, and the answer is never no. It may be a not right now, but here's what steps need to be taken. And a lot of times it's not as bad as you think. And so we just, we're here. We know that a lot of people have baggage, and there's, no one's perfect. And like I said before, we're not educated as a society with, financial literacy, so you're not alone in that. So we would love just to help guide you with judgment-free, conversations, and help figure out what needs to happen to get you where you want to go.
Absolutely. And what areas do you service?
Great question. So I am located in Fort Worth, but I service all of the DFW. In fact, all of Texas I could do. And in fact, I actually could lend in, there's like 34, 35 states across the United States. So I really can lend many places. But obviously if you want to meet with me in person, I'm in Fort Worth. So.
I was going to say, I'm going to pull the contact details in the description below. But if somebody wants to get hold of you, what's the best way for them to contact you?
So either text, call, or email.
And what's your phone number?
It is 682-226-7440. And then email is Kimi at Kimi Does Mortgages, which that will be in the description, because Kimi can be spelled a bajillion different ways. So.
Cool. And we've worked together on several transactions.
Yes.
It's always been a smooth process. It's
Yes.
always been good working with you.
Yeah.
And I appreciate this
Yes.
interview.
All right,
it's
thank
really
you.
Good.
All
Thank
right.
you. And like I said, all the contact details will be in the description below if you need to get hold of either myself or Kimi. And if you enjoyed this video, just don't forget to hit that notification bell and like and subscribe for more. Thank you.
Okay.